Good afternoon and welcome to the St James's Place Q&A call on the new framework for reporting financial performance. To ask a question, please press star followed by 1 on your telephone keypad. I'd now like to hand over to Caroline Waddington, Chief Financial Officer, for opening comments.
Thank you. Good afternoon, everyone, and thank you for joining the call. And I'm here today with Sophia Johnson from our Investor Relations team. Before I open the floor to questions, I want to spend a couple of minutes reiterating the key points about the new simplified framework for reporting financial performance that I'm very pleased to have announced today. Importantly, nothing about our profitability is changing. There is no change to our financial business model, anticipated profitability, financial ambitions, or shareholder returns guidance. The new framework is purely a change in how we present our results, with the aim of making them easier to understand and better aligned with our financial business model, charging structure, and statutory IFRS reporting. Our key profit metric is being renamed from the underlying cash result to adjusted IFRS profit after tax. This is the same number, just under a new label. As a result, we expect no material change to consensus profit expectations when you refresh your models to accommodate our new framework and associated guidance. Whilst the bottom line number isn't changing, the way we present financial performance to get to that bottom line is different. From half year 2026 onwards, we will replace the current cash result with an adjusted IFRS profit and loss account, which will show income and expenses separately and before tax. We're also simplifying parts of our financial review to make it easier to follow. To make the best use of this call for those on it, we'd ask that questions focus on the principles of our new framework. Of course, we recognise that you'll need to make changes to your models to adapt them to our new framework, and you may have detailed modelling questions as a result, and the IR team will be happy to assist with these offline. With that, it's over to the operator for the first question, please.
Thank you. To ask a question, please press star followed by 1 on your telephone keypad. If you change your mind, please press star followed by 2. Our first question today comes from Nasib Bahat from UBS. Your line is now open.
Hi, thanks for taking my question. So firstly, on the 131 basis points margin, I'd probably call it a revenue margin. If I gross it up for gestation from, so let's say if 25% is gestation, I get 175 basis points. Why is that higher than the 167 that you're charging under the new structure? So can you just kind of square the math there? And then secondly, just on below the line items, below the IFRS profit after tax, I don't think there's any changes there, but can you just confirm that in terms of how we model that? And just related to that on the DAC.
Yes, so on the first, I think if you gross up to gestation fund, it's about 15 basis points actually. So that's the amount. So that would be that, and then we've got some so I wouldn't get the 175 you said, whatever number you said, basis points. So I would think it's less than that. Then we have some tiering and we have some investment cost differences. So there are some different elements in that, but not the gestation fund. The gestation fund is a major difference, but not all of it. So maybe that's something you can go through with IR. Maybe you can go through that with IR.
Yeah, we can do the calculations for sure.
Yeah. And on the other side, there is no difference, no.
No difference. So the reconciling items between adjusted IFRS and pure IFRS are exactly the same as they were between the cash result and IFRS.
And sorry, I was going to ask on DAC and DIR, does that just run off over time?
The DIR does, and the DAC I think is going to remain as an accounting concept, but the DIR was very much related to our gestation fund and that 6-year holiday on fees charging. Okay. So yeah.
Perfect. Thank you, guys.
Thank you for the question.
Thank you. The next question is from Ben Bathurst from RBC. Your line is now open.
Hi both. Thanks for taking my question. Mine is on the IFRS expense note and that reconciliation from adjusted to IFRS expenses. I think it's slide 20 of the pack. Completely appreciate that nothing's changed here. The rec's calling out some specific line items, but there's also an other line in that rec. Is it fair to assume that depreciation and amortization of PPE is sitting within that other line? And is that offset by some credit items? And I just wondered, are there any other items worth calling out sitting in that other line that you think should recur and we should be aware of? Thank you.
Yeah, I would say actually we don't have that much depreciation from our PPE. We don't have a lot on our balance sheet. We have our, so I would say we don't have a huge amount of that. So that's not significant. The main thing in other expenses are sort of complaints costs and our donations to the foundation and things like that. So nothing particularly major. It's just all odds and sods that don't really, nothing particularly material that doesn't fit neatly into the other categories.
Okay, so the depreciation amortization is in there, it's just not material, would be the point.
I think it's actually within people. Sorry, I mean, I've been prepping so many questions. I'm getting my brain, and this was not one of them. I think it's within people, property, and technology costs. It should be within that. I think that's where we would find it.
Yeah, it was always recognised in controllable expenses previously.
Yes, it will be. Yes, it's within people, property, and technology, but it's pretty small for us. So it's because we don't have a lot of technology capitalised sort of software on our balance sheet. We don't have a lot of intangibles, so sort of through software and things like that. So it's small. Hence my brain. I mean to think about
Understood. No, that's clear. That's very clear. It's above the line. That's very clear. Thank you very much for that.
Yes, it is. Yes, it is.
Thank you. The next question is from Greg Simpson from BNP Paribas. Your line is now open.
Yeah, hi there. Maybe a few random ones here. In terms of the 3 basis point movement you're talking about, clearly that's going to be quite influenced by the gestation runoff, but you're not going to disclose that going forward. So I guess the question is 3 basis points. Is the 3 basis points going to be quite a similar level each year? 3 basis points? Are you going to kind of guide each year? Would it be 2 or 4? Just want to square that kind of how smooth that margin increase is.
Yeah, I mean, I'll start with that one. You see, I've stopped you asking multiple questions, but I will let you ask another question in a minute. So yeah, on the 3 basis point, I mean, that is our way of, obviously now we're using total fund, which helps simplify everything. That means you don't need to worry about the amount that's actually maturing. It is linear, but not totally linear. It does act in a sort of linear way, but not 100%. So what we will do every year is circa 3 basis points will stand every year. But what we will do is we'll give you the range of sort of where we think the average margin will be every year. So we'll reset the 47 to 49 basis points every year, and then it will be a circa 3 basis point rise every year after that. So that's what we will be doing in our guidance, if that makes sense.
Yeah. Okay. Got it. And a few smaller ones, but just you're excluding share-based compensation from your adjusted figures, just to confirm that's the case and remove the rationale. And the second one would just be just to confirm Asia and the Asia and Rowan Dartington revenues are all in your income from kind of top line, right? And the costs.
Yes, we've taken the opportunity just to simplify everything by putting so I'll start with the last one. Yes, we've taken the opportunity to simplify everything and put things with their, in their type of income rather than splitting it out by Asia and DFM. So yes, it's all in the income from firm and, profit from firm, profits from inflows and PPE. So that's where we split it out to. So yes, on that Asia and DFM. On the second one, it's the share-based compensation. If the equity settled is actually excluded from the cash results. That's aligned. Number one, that's aligned. The adjusted IFRS now, but was the cash result. So it's aligned across both. We've done the same thing in both. And just the rationale for that is that we can do that via either obviously issuing shares or purchasing shares, and only one of those impacts cash. So we do adjust it out. Because obviously there is that, it's not necessarily a cash item. And then when we do that, we will do that as our retained distribution. So out of the 30% we retain, it would be part of that if we do then purchase shares for that. So that's the rationale for it, and it is consistent with our previous treatment under the cash result.
Okay, got it. Thank you.
Thank you.
Thank you. The next question is from Charles Bennett of Rothschild & Co. Your line is now open.
Thanks. Hi, Caroline. One question on investment return and net finance income, which I think is driving 121 million out of the 600 million of adjusted PBT. So I think the slide says it reflects the income accruing on shareholder investments and net interest paid on borrowings. Can I ask a couple of clarification questions? One would be, can you remind us what the investments are that are generating the 86 million investment return? The second is, I think about the finance income. Is that net interest margin that you're generating on the roughly 9.6 billion pounds in cash that's reported with your fund? And where I'm coming from is I'm just trying to understand the net interest margin you're generating on client cash and the process you go through when thinking about idle cash that sits in SJP accounts versus being sent to Flagstone, which I think is excluded from fund.
Yes, it is. So I'll try and take that. So so the investments that we talk about is where we have put our working capital shareholder funds at money market funds. So that's our investment return. So it is literally a money market fund. So nothing more exciting than that. And on the second one, on the sort of finance income, this is predominantly interest on partner loans and cash and any cash and cash equivalents that are ours. So we don't make any interest on client balances. In fact, what we generally do with client balances is we invest in money market funds for them. So we don't have which other people will have, where we make money on cash of our clients. We don't have that situation. So all of that is our shareholder money or working capital money, effectively, either on money market funds, which comes in investment returns, or cash, and then obviously the interest we earn on partner finance comes into finance income.
Yeah, so nothing at all to do with the 9 billion sat within our fund.
Okay, so can I just follow up on that? On the client money notice section of your website, it says that the cash that's placed by clients gets placed in money market funds or bank accounts with treasury partners, and that there was a rate change effective 1st of January where a rate on cash was being reduced from 1.7 to 1.6, which I think would be different from the return that a money market fund generates. Do you know what this is referring to? It seems like there's a net interest margin there somewhere, but maybe I'm misinterpreting it.
We'll get back to you on that one, actually. We'll get back to you on that.
Sure.
Off the top of head, no. So, but yeah, we'll get back to you.
Okay, perfect. Thanks.
Thank you, Charles.
Thank you. The next question is from Andrew Crean from Autonomous. Your line is now open.
Hello there. I just wanted to ask, as we go down through the different lines, mainly expense lines, can you talk us through areas where you think there is seasonality between first half and second half that we ought to think about?
So there's not, where would there be seasonality? We don't have a huge amount of seasonality. I think probably our main one is within the FSCS and some of our regulatory fees where those payments come out in the first half of the year. So we do tend to get some more of that, but we don't tend to, certainly in our expenses, have as much of that sensitivity. I don't know, Sophia, if you...
So last year was a little bit of a quirk where we had additional higher expenses in the first half of the year compared to the second half.
True.
It was only very marginal, so it was something like 50.5 in the first half and 49.5 in the second half. Typically, we have a slightly higher H2 weighting, but by similar amounts, only just over 50%. Apart from FSCS, everything else is pretty even in general.
Well, I just want to take you up on that. Performance-related costs were 26 in the first half, 39 in the second. Other expenses, 28, going down to 18. People project costs, 256, 269. I can see that's sort of just general progression. But there do seem to be, and I just think on the income side, is there anything on the income from inflows or from fund which seasonally might be different? I'm just trying to think about it when doing the first half 26 forecast.
So on the income side, you'd expect us to move up within the 47 to 49 bps profits from fund range over the course of the year as gestation sum unwinds across the year. So yes, you'd expect the profit from fund margin to be higher in the second half than it is in the first half, but that is driven by the income side rather than the expense side in general. Of course, there'll be some fluctuations, so how we accrue for our profits and how we accrue for our bonuses in the performance-related line may vary as our assessment of business performance changes over time. But in general, a pretty even split on expenses is where we would suggest you are.
Okay. Great. Thanks.
Thanks, Andrew.
Thank you. As a reminder, if you'd like to ask a question, please press star followed by 1 on your telephone keypad now. The next question is from David McCann from Deutsche Bank. Your line is now open.
Yeah, afternoon. Thanks for taking my questions. Two from me, please. Caroline, on the pre-recorded remarks this morning, you were walking.
Oh.
Down to 131 that you're disclosing.
Sorry, David, we lost you for a second there. Can you just start your question again, please?
Yeah, of course. Yeah, sorry about that. So on Caroline's recorded remarks this morning, she mentioned that there was obviously a gap between the 167 for investment bonds and pensions and the 159 bits for unit trusts and ISAs, per the disclosures, comparing to the 131 that you're disclosing within the data today. Obviously, much of that is going to be the gestation difference. If I do 3 times 6, 3 basis points times 6, that's obviously about 18 bits. It doesn't explain all of it. I think it was also mentioned that the actual fund selection, will have a bearing on that. So can you just do a waterfall for us, if you like, between what's roughly 160 basis points down to the 131? So how much of that gap is gestation? How much is other stuff? And if you could sort of break that out by category, that'd be great. And then the second question sort of relates to the same thing. Of the 3 bits guidance of increase in the effective revenue margin, are you assuming any underlying fee compression within that, or is the 3 bits solely due to the gestation unwind?
So on the first one, Sophia, with the waterfall.
Yeah, so getting it up from the headline rates of 167 for bonds and pensions and 159 for ISAs and unit trusts down to the 131 we've actually reported. As you say, the most significant thing is gestation fund. The next largest thing is the variation in investment charges. Those headline illustrative rates just give an example for one particular fund, but we have quite a lot of variation across our investment portfolio. And so depending on where clients are choosing to invest, the charges are quite significantly different. We also have things like tiering going on in there, which brings down the margin. So we'd expect over time, as more of our gestation fund matures, that margin will trend upwards.
Can you put some rough numbers on those things?
Yeah, so in the same way that our profit from fund margin, we suggested we'll increase it around 3 bits a year, but we'll give you formal forward guidance for 1 year in advance. That 3 bits would also apply to the income from fund line, because gestation fund comes through free of any additional expenses in the way it always has. So a 3 bits increase due to gestation is what we'd expect out to 2031 annually.
Okay. So on the fee compression, I think the way we look on this is obviously the same way we've always looked at it. We think advice is something that, with the scarce resource in the industry, is something that will be one of the latter things to see any compression, if any, because of these obviously lack of advisors in the market. I think on the investment margin, that's something we're looking at, and we're permanently sort of reviewing that and seeing what the passes through to clients. And on the product, we obviously look at that as we get economies of scale. That may well be something that we will look at as time goes on, and that we get those economies of scale and what we do with them, and that's where we probably see it happening. Within our margin, we obviously have some degree of conservatism into that, but yeah, I mean, I think that's how we sort of see it going as time goes on.
Our old 43 to 45 bits.
Does the 3 basis points, is that exclusively the gestation unwind effect, or is there anything else in that number?
That is the gestation unwind effect.
Yeah. But as we had in our 43 to 45 bits margin range, that did assume, as you move up to 2031, that we could give up a bit or two on product charges. And so to get down to the same level of profitability, because the cash result is exactly the same as adjusted IFRS profit after tax, we've got that same level of prudence in our profits and sum guidance range too.
Thank you.
Thanks, David.
Thank you. We have a follow-up question from Nasib Bahat from UBS. Your line is now open.
So it was just picking up on what Sophia said on the 3 basis points. Your profit from FUM growing at 3 basis points, expenses aren't growing. So it seems like the income from FUM is going to grow at less than 3 basis points, right? Because you're getting operating leverage. All right?
No, we think that there will be 3 basis points on income from FUM and on profits from FUM.
Okay.
Yeah.
As a final reminder, if you'd like to ask any further questions, please press star followed by 1 on your telephone keypad. That concludes our questions for today. Sadhna, I'd like to hand back to Caroline to close the session.
Thank you. Thank you everyone for attending and listening and asking your questions today. So I want to leave you with my key takeaways. First, our new framework provides a simpler, clearer way of presenting the financial performance of our business. Second, there's no change to profitability, just a better way of showing the key drivers behind it. Third, we'll be implementing a new framework for our half-year 2026 results, which we'll announce on the 29th of July. So thank you all for your questions, and please do get in touch with our team for any further queries. Thank you.
This concludes today's call. Thank you for joining. You may now disconnect your lines.